to the commentary. Well, let me take it forward with Mr. Taimur Baig, MD and Chief Economist at DBS Bank, joining us on the show. A very good morning and thank you so much for our time. And firstly, help us with your take on the U.S. markets, because they seems to be digesting the Fed decision and taking cognizant of the fact that 2 more rate cuts are likely in 2025 and the record run continues. What's your current take on the U.S. markets? Do you believe that the rally can continue for some more time, or the growth concerns, the job-related concerns can weigh heavy in the near term?
Let's parse those issues maybe in 3 compartments: the growth concern, the job concerns, and the market-related concerns. So start with the last. Markets are certainly frothy, but maybe there is a reason for them to be frothy, because we are seeing a generational spike in investment on a disruptive technology. On the AI-related spending is stupendous, and the momentum is there, the liquidity and the funding is there. So that investment will continue and will prop up investment-driven growth in the U.S. for many quarters to come. I think that is a safe thing to say. Now, connect that with the point that will that actually lead to companies making lots of money? Is there a use case where the consumers will pay the way they pay for other things? That is still a big question. So we will have to have some sort of a reckoning, but that's not around the corner in the next few months. So I think the party can probably go on, especially the second issue, that the jobs market related dynamic, while on the surface looks weakening a bit, we think it's still pretty substantive in terms of wage growth, in terms of overall rate of unemployment. And mind you, the immigration related measures that the Trump administration has taken, which is causing some degree of labor market tightness, in an inverted manner actually creates upward wage outlook for the people who actually are in the labor force. So we may be not particularly happy with the labor market dynamic from a job creation or labor supply perspective, but on the wages side, it's okay. Finally, on the growth numbers, consumption is all right. It's not as strong as it was in the post-pandemic recovery phase, but it's okay. We have seen pretty decent retail sales numbers over the last 2-3 months. There is a great deal of anxiety around the trade war. There's a great deal of anxiety in the overall political health of the U.S. Society. That notwithstanding, we don't think we have any recessionary tendencies being displayed in the market. Typically, that comes from huge dislocation in the job market, a big financial market shock. Those things, in our view, is not necessarily in the horizon. They're always possible. There are always drivers that can end this party, but we don't really see it in the near-term horizon.
Sure. But Taimur, what is it that you're penciling in for the year ahead from the Fed? And does it seem like come the next policy and then too we will see further easing?
I think for the FOMC officials, doing these 25 basis points rate cuts in the next 2 meetings as a bit of a end of the year Christmas gift for the American people and keeping Donald Trump at bay, I think it's a pretty sad thing to do. I'm not entirely sure there's a very strong case for rate cuts right now, regardless of what the payrolls numbers is telling us. I think that from a risk management perspective, the Fed is better off holding some of these bullets to deploy in 2026, 27, when there may be genuine need for that. Having said that, what I think is irrelevant. What matters is what the Fed would do, and I will go with the market and calling for 2 more rate cuts in the remainder of the year. I think it gets very, very tricky in 2026. We will see a wide range of sources of inflation beginning to manifest. The tariff-related inflation is a drip impact, not a one-off impact, as some have thought. Companies will slowly start passing on the tariff to their consumers, and that would create an upward pressure on goods prices for a while. On energy, particularly electricity and related matters, we will see major upside pressure because of the big AI investment and the energy needs around that. On services, as the labor market gets tighter, great for those who have the jobs, but not necessarily great for those who need those employees to deliver those services. So hospitality, agriculture, construction, we might see upward pressure. So I think right now the Fed can go ahead and do whatever it takes to make Trump happy. 2026 would be a whole different ballgame. If they go ahead and keep cutting rates, the market might start challenging that, and we might see some curve steepening and battles around that.
Great. Okay, Taimur, great to have you on the show. Thank you so much for that insight and perspective.